Let's start with that buoyancy in risk assets. Yes, the Asia session looks good. European futures look higher. US futures also higher. Yesterday's equity market picture was a little more confused. How much of a bull market are we looking at here?
We're in a proper bull market, and what I mean by that is that we shouldn't get too bothered by the short-term moves. We're going to have more fluctuations in the week ahead. We might sell off tomorrow. It does not mean that we're not in a bull market. The reason that we're in a structural bull market is that we have the most important central bank in the world pumping another injection of animal spirits, of stimulus into the arm of an economy that is doing absolutely fine. Atlanta Fed GDP now just ticked up to 3%. Growth in the US is likely to be this year as good as last year, if not better. Growth this quarter in the US is likely to be better than last quarter. Growth this year globally is likely to be better than last year. I don't know where this slowdown is. There are certain sectors, if you look for them, sure. Hiring's slowing down from a crazy level. Retail sales are slowing down from a crazy level. But overall growth is good, and yet central banks are easing. This is bull market conditions. It does not get much better than this. Now, it's not a short-term call. Of course, things are buoyant today, but it's not saying they're going to continue at this pace, because they definitely won't.
What happens if the market doesn't get the rate cuts it now expects? The market has put this in the rearview mirror. This is done and dusted. We didn't get a big reaction to it. We'd already priced it in. What happens now? Because at the moment, the market is still expecting the Fed to be much, much more dovish than is priced by the dots.
They won't get the rate cuts that are priced. I just don't see it. It's going to be like in December. In December, we priced 6 cuts to have already happened by now. Went crazy, and yet the market kept on rallying, and the yield curve kept on steepening. And what we're going to see exactly again, we're going to see yields overall, probably even at the front end, go a little bit higher over the next coming months. But really, we're going to see steepening of the curve because the Fed have said a very, very clear message that whenever it's important, they only really have one mandate. They don't have a dual mandate. They don't really care about inflation. They don't care about inflation in a responsible, long-term, sustainable way. And therefore, they're complacent about inflation, and they care about the labour market. And that means they're giving another jolt to the economy. And that is positive for stocks. So the rate cuts will be slowly priced out over time, but they're being priced out because the economy is fine and stock markets are doing fine. Those rate cuts will only come in at such an aggressive level when a true crisis arrives. And there's no sign of one just now, especially now that the Fed has reignited animal spirits.
OK, so reigniting animal spirits. And what did that do to the dollar then, Mark? Because we saw it drop initially, as you might expect, on that bigger, outsized move in rates. But then it started to gain. It's down again today. But what does the trajectory look like for the dollar?
The dollar is the most difficult asset to call because the yen should weaken again. We're back in a risk-on environment. Carry trades will be reignited, and the structural reasons for yen depreciation have not gone away. Still, the only major economy in the world that's not expected to grow this year. Still got the world's largest debt pile relative to GDP. Still got the most deeply negative real yields. That's not changing. But the dollar will suffer against emerging markets, against high yielders, against commodity currencies. Net for the Bloomberg dollar index, it balances out.